It's going to be the end of the world, Bill. See?
But we had, as you mentioned, consumer sentiment. And there's some aspects under this that are kind of maybe stoking the fire here a little bit for future rate hikes. No, so we had buying conditions for durable goods were considered favorable. We had an uptick in durable goods last week. The other thing to keep in mind, and we've talked about a number of times in these conversations, is, you have a Fed funds rate at 5.25, 5.5. Man, if they get to the 6 handle, what is money market funds paying? What are savings account paying? So savers are getting juiced right now to hang tight. They're getting paid to wait. And you've mentioned higher rates ultimately are inflationary to a period of time because people are getting handed, and to some extent, free liquidity. Maybe it's a burden on the government, but the consumer right now maybe is feeling a little cashed up. Now, in the housing market, which is just one of these lurking elephants in the room, everyone's got a hot opinion on housing. Everyone thinks that Airbnb, short-term rental, people getting multiple properties that are investment properties, and that's going to lead to the crash. We haven't really seen any movement in housing prices. The purchase applications index hit a in 1995 low. So there's just zero activity. And I mention that because it feels a little bit like, during the COVID lockdowns, we had this huge surge in durable goods and people were like, well, shoot, I'm in this house. It's time to remodel. It's time to put the addition on. People are almost locked down into their low rate mortgages and aren't moving. I wonder if we're going to see another surge of inflation because of a second durable goods home reinvestment wave that potentially means there's more than just one rate hike on the table in the future.
Yeah, it certainly could. And I'm the first person to say that I am not a real estate expert. It's certainly not a individual home real estate expert. But all the guys I know that are, and, that played the Big Short back in the mid 2000s and made money on it, none of them are bearish housing right now. So, to me, if they saw the same opportunity again, knowing the success they'd already have, I would think that they would be back into that trade. And from what I can tell and from the conversations I've had, they're not. And so I think there is a little bit of the fact that maybe they're not, they're not trading up. They're in the house. They're going to stay there instead of, using whatever cash or whatever they have to go get a bigger house. They're just going to, build up the one that they have. I think where there's a lot more chance for market volatility or a problem is in commercial real estate as opposed to, the individual real estate.
Yeah, you had highlighted at least one interesting example around that. Now I'm so subconscious of the word interesting, I'm going to keep saying it. but you shared a tweet that highlighted the apartment building. Was it office or was it a residential?
An office building. Office building.
So huge discounted sale. Was it 66% off of appraised value?
Yeah, it was 60 Spear Street in San Francisco, which is kind of the heart of the financial district. And I think I knew some people that used to actually be in that building. And Credit Suisse was right next door to it when I was in San Francisco, or at least one of the Credit Suisse offices. But it recently sold, and it sold at 66% off assessed value. So, that's a pretty decent haircut, right? And that's important for a couple reasons, because it sets a precedent, right? We've talked before, like if you have an asset and you just hold on to it for a long time and the accounting rules don't make you market to market, then you can hold that asset for a really long time without it negatively affecting it, as long as you have enough cash coming in to continue operations. Where it starts to be a problem is when your neighbor or somebody across the street or across town does have to sell. And then, something that's comped similar to the asset you own is now at 50% lower than what you're holding it at, right? And that's a big deal. And then the next person has to sell, and all of a sudden, valuations start coming down. And so when people either sell because they want to or sell because they have to, that's when things can get reset. And the reason this is a big problem is I'm not the first to bring this up. This has been out there for a very long time, that there is a lot of dormant or vacant, however you want to describe this, dead commercial real estate. I don't think post-COVID we're ever going to go back to working in the office to the same level that we were before. I do think it'll come back to a certain extent, and there will be exceptions to the norm. But by and large, especially with the rise of technology and the ease with which people can work remotely, I just don't think we're going back to where everybody does the 9 to 5 in an office and everybody has their own office. And so there's just all this extra space that isn't needed. And, the banks, have been able to keep the loans on their balance sheet at par because the companies so far haven't had to leave. But now as things start to get refinanced, right? Leases come up and they got to release them, or loans come due and they got to refinance them, and rates are now 3 times or 2 times or 5 times, whatever it is, higher than they were when those either loans or leases were originally put on. It's going to be a much different thing. So now the payments are much higher. The firms don't need, the companies that have these leases or these loans, they don't need as much space, and they're going to be exiting. And these corporate landlords they're screwed. I mean, that's about the best way to say it in my opinion. And the problem is they can hold out for a long time, but once their neighbors start selling, which again, this just happened the other day in San Francisco. Now you've got a comp. And so the next person, if anybody was thinking about buying the building next door and paying full price, well, that's been shot to hell, right? So it can have, and here's why it becomes even more important. Not only is it bad for the commercial real estate operators, but it becomes bad for the banks that hold those loans. And what we talked about back in the spring, the big problem they had back in spring was the banks, the small and regional banks. Those were the ones most likely to go bankrupt. And we talked about how we think the trend in community banks is probably going to continue to fall. Well, probably won't surprise people to learn this, but maybe it will, is that most of commercial real estate is held by the small and regional banks as opposed to the big mega banks. Mainly because they know their markets better than some of the bigger commercial banks. So, as we start to get more problems in the commercial real estate industry, we're going to get back to the banks, where banks start getting in trouble. And as banks start getting in trouble, customers are going to pull their deposits out of there because they're not going to sure if their bank is going to be solvent or not, or if it's going to be safe or not. So then they take their money out of there and they put it in their brokerage account in order to buy treasury bills, or they move it to a big mega bank where they can get, buy treasury bills or something. Because why have your money in a small regional bank that maybe pays you 2 or 3.5% on a money market fund, and it might go bankrupt, when you can put your money in treasury bills and you're going to get it back, right? The government's not going to default on treasury bills. So, all of this stuff is related. And as this is part of the reason why, I've remained kind of steadfast in my view that we're due for some volatility, because this is just another thing that's out there. And the longer you go on, the more likely these kind of landmines are going to start to go off. And once one goes off, it has the potential to cause others to go off.
Well, I think I've got the headline for our thumbnail: landlords are screwed. So, I appreciate that. Yeah. So I appreciate that soundbite. There's a lot to attack there, and I'm glad you kind of took it in all those various directions, because there's definitely some points to highlight. You talk about this comparable aspect of once one person, has the discount, how it has that domino effect. And I think back to 2009, there's this initial denial, right? You have a foreclosure, and I'm talking the residential market at that time. And
Yep.
You'd say, hey, my house isn't worth that much. That's a foreclosure. And people would try to exclude it from comps as if it was some sort of outlier that wasn't relevant. And they very quickly learned that a comp is a comp. And just because a property sold under distress, it doesn't mean that suddenly that's not how your property is going to be measured, especially when you start to have a inventory of distress assets. And if you're in a position where you need to liquidate or raise capital, it doesn't matter that you're not bankrupt. What matters is the people around you are, and you need a quick sale. There's no arguing with the reality of what, price is indicating. So I think that is a painful reality for commercial real estate, and selling at 66% below assessed value comes with a lot of question marks and a lot of concerns, because assessed value is a tax assessment generally. And
absolutely.
So this kind of tells you where the direction of California's tax receipts are headed. Because how long can assessed value on a tax basis be held 66% above where assets are actually trading? So that, that starts to become a factor as well. And the other thing with commercial real estate is the real market value typically is traded based on net operating incomes. And so those cash flows are completely collapsing. So how would you even, depending on what cap rate you chose, how would you even begin to mark value on an asset where there's no income? And this is where it gets extremely dicey, like you said, for the various banks that are invested in this or hold the CMBS or maybe have a portfolio commercial loan on their books. And that's what's kind of happening here from a distress standpoint. You have these assets, if they aren't selling at some kind of fire sale price, these commercial landlords, so to speak, that are screwed are simply walking away from the asset. And so maybe this is, as you mentioned, a landmine. Maybe there's a ticking time bomb behind it as well.
Yeah, and I think the denial comment that you used is really good, because it's not just the landlords who are in denial. It's the banks who are in a little bit denial, or at least pretending that they don't know what's going on. And then, but the governments, right? The city governments, the state governments, the county governments, they're all in a little bit of denial too, because their tax revenue is based on it, and they certainly don't want to cut spending. They certainly don't want to cut their budget. They certainly don't want their projects not to get funded. But to your point, this is a tax issue, because once the commercial real estate, and these are some of the biggest taxpayers, right? It's not just that they're taxpayers; they're some of the biggest taxpayers. And so, when a building gets 66% off, the tax revenue on that is now 66% off, unless they levy new taxes, right? And nobody likes to levy new taxes. And the other part of deniability or denial is that this is a big functions of markets. I mean, this is a hallmark of markets. And I'm reminded of Kyle Bass and Mark Hart. So those are two guys that, they made a killing. They kind of made their name for themselves as extremely successful investors, made a lot of money in the housing meltdown in 2008 and 9. And, they would go around the country, and they would go to Seattle, and the potential, when they were raising the money for the fund, they would present their case why this was going to be a real estate disaster. And they'd go to Seattle, and the people there in Seattle say, wow, this is a really great idea. It's not going to happen in Seattle for all these reasons, but if the rest of the country, yeah, they're screwed. And then they would go to Denver, and Denver would say, yeah, this is a big problem. It's not going to happen in Denver because da-da-da-da. But, the rest of the country, they're screwed. They'd go to Miami, they'd go to Toronto, they'd go to Dallas, they'd go to New York. Everybody would explain that their country, or their city had these unique advantages that was going to preclude it from participating in this market meltdown. And it basically became the NIMBY argument, right? The not in my backyard. and they, of course, they knew they would come out of these meetings. And I've talked about this, so I know that they'd come out of these meetings and they would just look at each other, and they knew, right? Because every city was telling them the same thing. And the reality is once a problem gets big enough, even if you are not one of the quote unquote centers, and even if you took care of yourself, you are going to be impacted. So anybody who thinks that they have it all figured out, right? They have the magic bullet. They've got gold, they've got Bitcoin, they've got land, they've got whatever it is that they have figured out, they think that they're not going to be impacted. Let me tell you, if this happens, everybody will be impacted. It has the potential to be one of these events where you just can't escape from it. Now, are we going to have another global financial crisis? Listen, I don't know if we are or not. I just know that the markets are set up that if certain things happen, that could happen again. And I think it's important to understand why it could happen and how it could happen.
Yeah, those cascades are definitely important to to put a spotlight on like you just did, especially since we were kind of highlighting California and throughout all of this banking crisis issue, real estate issue, housing crash is coming, commercial real estate crash is coming. It's easy to beat up on the guy with the black eye in San Francisco, and California has been the punching bag for that. Meanwhile, everyone in the South, whether it's Texas or Florida or some of these other states that have benefited from their better or more attractive tax policies and therefore have seen more migration, have kind of had the narrative or the attitude that they're invincible to these things because look how hot things are here. So careful carrying that chip on your shoulder. This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.